75 basis points, 0.75%, just hit the tape a few minutes ago after Jerome Powell took it off the table last month. Whoops. J-pow, you got some splaining to do. What's up, everybody? I am nobody special, and welcome to this very special time of the month. We have got Jerome Powell's press conference following the FOMC, or the Fed Open Market Committee, meeting today. The Federal Reserve was expected, up until a few days ago, to hike interest rates by 50 basis points, or 0.5%. Well, after that blowout inflation number that we got on Friday, the market started to get a little nervous that a 75 basis point rate hike might be coming today. And Jerome Powell last month said, no, we're not going to do that. We're only going to do 50 basis points. Well, just a few minutes ago, while a lot of you guys were waiting, they raised rates by 75 basis points. So Jerome Powell, expect him to face some questions about that. Expect some of these reporters, journalists to raise questions about his credibility during the Q&A period. For folks who are new here, by the way, I just want to show you a little bit of what's going on down on the screen. I have got new this month is down in the lower corner there, Jerome Powell's tool counter. We'll be keeping track of every time Jerome Powell makes mention of his tools. j-pow just loves to talk about his tools. The number to beat is 9. Last month, Jerome Powell mentioned his tools to fight inflation and stabilize the economy 9 times. We'll see if he breaks that record today. All right, we've also got down in the other end of the screen, we've got several charts prepared for you so we can watch market reactions in real time to what's going on. We've got the S&P 500. I've also got the Dow, the NASDAQ. We've got the 10-year Treasury, the 2-year Treasury, gold, silver, my favorite of the shiny metals, crude oil, and of course the Dixie. That's a new one we're going to watch this week because right now the dollar is getting stronger, 105.72, up 20 basis points right now. That's a big deal because this is the dollar milkshake theory, Brent Johnson's theory about the dollar strengthening as global currencies are inflated away. Even amid high inflation, we're watching that in real time right now. The dollar is getting stronger. So we're going to be flipping through these charts as Powell is speaking. And then, of course, in the middle of your screen here, you will have the Federal Reserve. This is where you'll see Jerome Powell himself, and you'll hear him talking. And let's see what they have going on right now. He's expected to start in about 12 minutes. Oh, that's nice. Got some mood music. They always give us this lovely music right before Powell starts talking. Like we're standing in a breezy field. Almost forget. Make you forget you're being robbed, that your savings is being looted by inflation, that your dreams of owning a home were just dashed because they raised interest rates. But hey, they gave us breezy music, so thanks for that, Federal Reserve. Now, this is important. There are 692, according to my numbers right here, of you watching right now. And I want to get a big number on this stream because this really grinds my gears, what is going on with the Federal Reserve and what they are doing. And I mean the central bankers, the politicians, the elites, the World Economic Forum, all of these people who play games like checkers and chess with our lives, with our savings, with our work. I want you to get this stream out to as many people as possible, all right? I want you to text it, share it in other social media, tweet it out, anything, get the word out, all right? And think about that kid that just graduated, all right? He just walked. You just watched his graduation a couple days ago, and now we're heading into massive unemployment because of what they're doing in the debt market and the collapse in the economy that's coming. His career prospects were just pulled out from under him before his career even started. Think about that couple that's about to get married. Maybe you got an invitation to their wedding. It's this weekend or it's next weekend. And their dreams of owning a home were just moved, just a little bit beyond their reach by Powell's rate hike. By the way, have you seen what mortgage rates are doing as they hike interest rates? Yeah, the cost of the average home, the median home in the United States, the interest payment or the mortgage payment on that went up $147 since Friday because of what they're doing in the debt markets. The same home, the same price, it's $147 a month more expensive now. So think about that couple that's about to get married. Think about your friend, your relative that's struggling to get out of credit card debt. All right, maybe they made some mistakes when they were shopping a few years ago, but they're trying to turn their life around. They're trying to work their way out of debt. Well, their interest rate just got jacked up. It's going to be even harder for them to climb out of that debt. Think about grandma. Saved her whole life, lived responsibly. And now she's had her savings absolutely looted by inflation. Meanwhile, these government bureaucrats, just like Jerome Powell, they go on TV and they lie about how bad inflation is so they don't have to give grandma a raise on her Social Security benefits. I want you to think of all those people, because most of these people that I just mentioned have no idea what the Federal Reserve does and how much it affects their lives. They think that, no, this is just something that affects rich people. It doesn't affect me. I don't get involved in all that market stuff. It has nothing to do with me. Not realizing that they are being shoved around a board like a pawn on a chessboard. And I want you to think of them, and I want to get this out to all of them right now, because what is going to happen, what's going to be said in the next few minutes is going to have a huge, huge impact on their life. And they need to know it. They need to know it in real time. And we're going to react to it in real time. We're going to put it in words that they can understand, so people can realize what's being done to their lives and understand this isn't a left-right thing. This isn't a rich-poor thing. This is they and everybody else. They being the global elite ruling class who wants to rig markets for their benefit at our expense. All right, Jack, get off your soapbox. We are now 9 minutes away from Powell starting talking, and I have to send a shout-out to my man Harry Dan 2 from Tunes More and Otherwise for your super chat. Thank you very much, Harry Dan, who says, J-Pow had to do the 75-point hike because that's what the market priced in. It's better to satisfy the market than shock it, even though 75 basis point hike is a joke with that 8.6% print. Thanks for what you do. Well, thank you very much, Harry Dan, too, for what you do, for your comment, for your support of the channel. I appreciate that very much. It's an interesting take that Powell had to do the 75-point hike because that's what the market was expecting. See, I'm a little more surprised that he did the 75-point hike, and I got to eat a little bit of crow here because I was in my live stream yesterday saying I didn't think he'd do 75. I thought he'd do 50 because he took 75 off the table last month, and Powell doesn't like to surprise. He likes to telegraph long in advance of what he does. So I was actually leaning towards 50, and I put out a poll on my live stream yesterday, and it was pretty evenly split between 50 and 75. Well, the 75s have it. By the way, I got to send a shout out to my moderator, Mish. He called 75. The Economic Ninja, he said 75. Me and Chris Taylor, we both said 50. We ended up getting 75. But that's an interesting take that the market was expecting it, so he kind of had to give the market what it wanted. And I agree, it is a joke in light of the 8.6% inflation print, which is grossly understated. Understand that 8.6% inflation, actual inflation, if you go by shadowstats.com, which uses consistent methodology to calculate inflation based on the way they used to do it back in the 70s and the 80s, the actual rate of inflation is closer to 18 to 20% right now. All right, so the government is saying 8.6, and that's why I mentioned grandma, who's on a fixed income, who saved her whole life. Her income is being held back because they won't tell the truth about inflation. All right, if they told the truth about inflation, if we had 18% CPI prints, well, then they'd have to give grandma a bigger Social Security payout, wouldn't they? Of course, grandma's savings is being eroded away. So grandma, unfortunately, is getting squeezed at both ends by what the Fed and the Bureau of Labor Statistics and the government people are doing. But thank you so much, Harry Dantu. I appreciate that very much. And we're at 937. I want 1,000, folks. I want 1,000 on this stream. Keep sharing this. Send this out to everybody. Again, people have no idea how much this affects their lives. They think this is just something that affects the banks or the Wall Street guys or the CEOs. No, this is about everyday people. This is how they get so wealthy. This is the wealth gap that the politicians love to posture about and pay lip service to. All right, this is where it comes from. It doesn't come from some tax policy. It doesn't come from some other program or government handout. No, it comes from weaponized inflation that has been used to destroy the middle class, particularly in the United States, since the 1970s. If you were lucky, if you were one of the lucky few, you escaped the middle class into the upper middle class, where you're struggling to stay there right now because of inflation. But most folks were pushed down almost below the poverty line into the working class. And right now they're being held there because most people are trying to save up to get somewhere, save up to buy a house, save up to get out of debt. They can't because that savings is being eroded faster than they can save it. The inflation is just eating away at it. And where is all that value going? It's going to the elites. It's going to the wealthy because they own assets, assets that have absolutely ballooned in value since they've started this inflationary cycle. And I just want to mention, folks, that this is a man-made disaster, what's going on right now. All right, we had The lockdowns, man-made disaster. They printed all the money, man-made disaster. Then they're marching us off to war in Eastern Europe, man-made disaster. All of these things are man-made. They are caused by these ruling class elites, these central bankers, these politicians. So the more people we get this message out to, the better. And real quick, I also have to say thank you to Lloyd Brett. Thank you, sir, very much for the super chat. I appreciate the support of the channel, sir. And Lloyd says, I think we have another 8% plus CPI print, and it will force the Fed to raise to 100 basis points. It might be a little early to call that, but I would not be surprised. Definitely the 8% print on CPI. I think that's all but a given. With what's going on in energy markets and what's to come in food markets, I think an 8% print. Absolutely, Lloyd. Absolutely. Might be a little early to call a 100 basis point rate hike, but if you look at some of the projections, and Powell may get a question on that today. Let's see. Maybe Powell puts the 100 basis point hike on the table. Boy, the markets won't like that if he does that. I can tell you that very much. Anyways, folks, we are 4 minutes away. Thanks again, Lloyd Brett. I appreciate very much the super chat, sir. We're 4 minutes away from starting. Let's do a real quick run through the indexes and see what is going on, how the markets are reacting. As you can see right now, the S&P is pretty much all over the place since that hike hit the tape. It was still up about 20 points on the day, or about 0.5%. The Dow Jones is also clinging to positive territory, up 34 points, or about 0.1%. The NASDAQ is way higher still for some reason. That's risk on in this market. Why? I could not tell you. This defies logic, but it's up 153 points, or 1.4%. I just want to warn you guys that sometimes the algorithms make massive moves on these Fed announcements only to have them reverse like that the next day. So be careful. Not a financial advisor, not financial advice, all that CYMIA stuff, but be careful trading these big moves. If you remember last month, we had a huge rally when Powell took that 75 basis point hike off the table, only to watch it all evaporate the following day, and then markets headed much, much lower from there. So be careful. Don't get too caught up in this algorithmic trading right now. This is software programs throwing around billions of dollars, and you don't have the firepower or the reaction time to keep up with it. So that's just something to keep in mind, folks. Now, 2:28, we have 2 minutes left before Powell starts talking. Still got the mood music playing. Oh, that is just lovely. I will go on mute most of the time while Powell's talking. I'll chime in if I see something that really grinds my gears. And I'll be cycling through the charts just so we can see the various impact that's having on markets right now. In particular, gold right now, still positive for the day, up a little bit after that announcement. Again, we have just a couple of minutes here. They usually start right on time. We're still 2 minutes out. And by the way, we had a poll going on. I'm going to end this poll right now because the press conference is about to start. But 42% of you have said markets will sell off on Powell's press conference. About 30% of you said, meh, nothing much. Nothing's really going to happen. And we've got 28 are calling for a relief rally. So we will see where that one goes. I am going to end that poll there because the press conference is about to start. No change in your vote once the press conference is started. One more time, folks, please get the word out about this meeting. Let people know. We have 1.1 thousand people, 1,100 people watching right now. That is awesome. Thank you guys for helping getting the word out. Remember, people have no idea just how much of an impact this has on their lives. Most people think this has nothing to do with them. It's just something that affects the rich. This really, this is what drives that wealth gap. This is what makes them so rich and us so poor. This is what makes your wages devalued versus your cost of living. And it's all that easy money printing and everything that the Fed did in response to the unfortunate health situation that I can't talk about on YouTube that has caused this inflation. And now it is this reactionary Fed that is way too late after telling us the inflation was transitory for the better part of a year and a half. Now they're cranking on the interest rate hikes. They're driving up the cost of debt, and they're going to crash our economy and our housing market, trying to overreact to the inflation that they caused. And that's why I keep saying this is a man-made disaster. This is absolutely being done to us. This is not, they're going to tell you that this is because of the invasion. They're going to tell you that this is because of the health, the pandemic, and everything else. And yeah, those things are contributing factors, but it's the money printing. It is the 50 years of easy monetary policy, really going all the way back to Alan Greenspan. that has caused this immense asset bubble that we have in stocks, in housing, in everything. And we are now 2:30. The press conference could start at any moment here. And real quick, I got to say thank you very much to Mars Beetlejuice for the super. Appreciate it very much, sir. Appreciate the support of the channel. And I've got Mr. Charles Dowling. Thank you, sir, also for the super. I appreciate it. No messages from those guys, just a thumbs up. So thank you, guys. Appreciate that very much. And what is going on? Where is the Fed? It's 2:31. j-pow, you're late. We're going to refresh this window. Just see if that has
on
anything.
behalf of
There
American
he is.
families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials
Very comforting,
like
Jay.
food, housing, and transportation.
He's acutely aware. Isn't that comforting, folks?
We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
It's way behind on the tool counter today. Way behind. Got to get those rookie
Thank you.
numbers,
Howard
Jay.
Schneider with Reuters. Two related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So As you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, and we thought, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Okay, Gina?
Thanks for taking our questions. Gina Smilek with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have, and why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
Steve.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year, do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask, all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand, and that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still pushing upward on inflation. So that's really how I would think about it.
But does 3.8%, 4% get it done? Does it get the job done of breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days, so I would think it would. But you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you, Nick.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see.
Total non-answer.
If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised. Nonetheless, it was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data, and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up.
He didn't put 100
and then
on the
pretty
table,
soon we'll
but
be
he
in an
didn't
area
take it off either.
where
He left it open.
I think
Market's not
as you
going to
get
like that.
closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Neil.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance. And so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be any guidance that we give is always going to be subject to
market is telling you you're not moving fast enough,
things
Jay.
working out about as we expect.
It's not telling you you're doing a good
and
job.
in this particular
It's telling you go
situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause, even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point, and we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late during blackout, very close to our meeting. Very unusual to one that would actually change the outcome. So I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, one or two times. So I don't think it's something that'll come up a great deal.
Colby.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down. So, but and right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and again, we're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done, because we saw, and frankly, we saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation of our policy is going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear
Another non-answer.
is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take for example in the labor market. So you have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained.
Terrible
right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So, You're right. In the SEP, we have unemployment going up to 4 point. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where, where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place. But to get there, it's not going to happen with the levels of inflation we have. So we have to restore that. And it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate in the SEPs over the next couple years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
We're not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. It just didn't, the sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear, what you're seeing is the situation getting more difficult. And you look around the world, I mean, lots of countries are looking at inflation of 10%. And it's largely due to commodities prices. But all over the world, you're seeing these effects. And so, and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really, and by the way, headline inflation is important for expectations. The public's expectations, why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're, of course, watching very, very carefully for that, and looking at the retail sale, the big store numbers and all that kind of thing. And so, but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people.
Did he really just say that?
That's
really?
That's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but it's still at quite robust levels. We see the economy slowing a bit, but still growth levels, healthy growth levels.
So then, as you are raising rates in this economy, how closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending, but we watch everything. We watch business fixed investment, which actually has softened a bit, and we're responsible for watching everything. But consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately, it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
See the way he touched his face right after he said that?
Radio and television.
That's his tell. He just lied.
Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. We, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect, really. I mean, the energy prices are set by global commodity prices, and most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too. Also other things. So we can't really have much of an effect. But we have to be mindful of the potential effect on inflation expectations from headlines. So it's a very difficult situation to be in, and we can't do much about the difference between the elements that make up headline that are not in core.
Could I just, as a follow-up, get a clarification on the SEP? When the members gave their forecasts, when were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point move?
The SEP is of one piece. It reflects all of the economic readings. It also reflects the 75 basis point increase. This is important. So people had that in hand when their SEPs were submitted. So in other words, it's not in addition to what's in the SEP. The SEP, everyone's SEP reflects their thinking about this rate increase and what's going forward.
Victoria.
Hi, Victoria Guida from Politico. I wanted to ask about how you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to see inflation coming down over a series of reports, and I guess I'm curious whether you think inflation data itself is a really good indicator, or whether you might be concerned that it's a lagging indicator, or that it might send confusing signals, given that, as you've talked about, there are sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
So I think the role that we can play, maybe the way to get at it is to say that the role that we can play is around demand, right? So, and we'll be able to see the areas that we can affect are those that are associated with excess demand. And we'll be able to see our effect on, for example, job openings in real time. So, and that would tell us about wages. Wages are not principally responsible for the inflation that we're seeing, but going forward, they would be very important, particularly in the service sector. So, sorry, I'm not sure I'm getting to your question.
My question is inflation data itself the best indicator for when you're getting to where you need to go, or might it lead you to go too far?
There's always a risk of going too far or going not far enough. And it's going to be a very difficult judgment to make, or maybe not. Maybe it'll be really clear. But we're quite mindful of the dangers. But I will say the worst mistake we could make would be to fail, which it's not an option. We have to restore price stability. We really do. Because everything, it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work the way it's supposed to. It won't work for people. Their wages will be being eaten up. So we want to get the job done. This inflation happened relatively recently. We don't think that it's affecting expectations in any kind of fundamental way. We don't think that we're seeing a wage price spiral. We think that the public generally sees us as very likely to be successful in getting inflation down to 2%, and that's critical. It's absolutely key to the whole thing.
It just
that
essentially
we
said
sustain
it's
that
good
confidence.
that wages
So
aren't
that's
going
how we're
up
thinking
as
about
high
it.
as inflation. That's what he said. It's a good thing our lives are getting harder.
Hi, Brian Chung with Yahoo Finance. I just want to expand, I guess, on what you just said now about the general public feeling like you can get this done. When you talk about consumer sentiment being down, household inflation expectations being up, recession just broadly being dinner table talk, does the general feel among American households and also businesses square with your explanation of the economy, given that the description of inflation in the statement didn't change between May and June? Thanks.
So clearly, people don't like inflation a lot, and many people are experiencing it really for the first time, because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways. And we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. I'm not.
He wouldn't have
clearly,
waited this long to act.
It's an incredibly unpopular thing.
He has no idea how hard this is
and it's very painful for people. So, but I guess what I'm saying is the question, the really critical question from the perspective of doing our job, is making sure that the public does have confidence that we have the tools and will use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down, but we will do that.
Chris.
Thank you. Chris Rugaber at Associated Press. You have talked about inflation a few times and mentioned oil prices, China lockdowns. But aside from rises in commodity prices such as gas prices, we're also seeing stickier measures of inflation increasing, such as the Cleveland Fed's median and trimmed mean CPIs. I mean, how persistent do you see those underlying measures of inflation, and how do you expect to, where do you see those going in the near future?
Yeah. So, as I mentioned, I think in my opening statement, the inflation has started off in quite narrow, very directly pandemic-related areas, and it's spread now broadly across the economy and into the services sector as well. It was really in the goods sector at the beginning. In particular, you're seeing in travel now, if you've flown on a plane lately, planes are very full and plane tickets are very expensive. Some of that will be passed through of energy prices, but so you're experiencing services inflation. Shelter inflation is high. So the question, and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing progress, and we want to see progress, and that's really another part of why we did what we did today, and why the SEP looks like it does, is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Do you still think a softish landing is possible, and how would you define that at this point, considering the revised projections for unemployment, GDP, inflation?
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. I would call that as meeting that test. Do I still think that we can do that? I do. I think there's. I don't want to be the handicapper here. That is our objective. And I do think it's possible. Like I said, though, I think that events of the last few months
0%
have
chance
raised the degree of difficulty, created great challenges.
4.1% unemployment.
And again, the answer to the question,
0%
can we
chance
still
of
do
that
it? There's a much bigger chance now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices could wind up taking that option out of our hands. So we just don't know. But we're focused on, very, very focused on getting inflation back down to 2%, which we think is essential for the benefit of the public, and also to put us on a path back to a sustainably strong labor market like the one we had before the pandemic.
Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that now there's even more risk of a recession than a 50-50 path of rates. So could you talk a little bit more about that, and what evidence would get you to stop rate hikes and maybe even reverse them?
Sure. So, as I mentioned, financial conditions have tightened over the last 7 months, and that's a good thing, we think. But the federal funds rate, even after this increase, is at 1.6%. So it's hard to see how that is too high of a rate. And even if we did another, we're going to get here by the end of the summer somewhere in the 2s probably. Still, that's still a low rate. So that's not a rate that is calculated to bring a recession on. And by then we'll have seen a whole lot more data. As I mentioned a couple times, the committee's views are around a modestly restrictive stance, which would be in the 3 to 3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today. We'll be watching if things go in a direction we don't expect, then we're going to adapt. And I would say this is a highly uncertain environment, extraordinarily uncertain environment. So again, we'll be determined and resolved, but flexible.
Hey, Evan.
Evan Reiser, Market News International. Thank you, Chair Powell. I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public? And then secondly, given the illiquidity and extraordinary volatility in financial markets, are you concerned that QT will make that worse?
Sorry, what was your question on QT?
First mention of QT?
Just given
in this,
the illiquidity
Q&A.
and extraordinary volatility in financial markets, whether QT will make things worse.
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent. It's hard to overstate the extent of interest we have in that question, morning, noon, and night. So, but you have to understand the context. Really, the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. It is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So we have now experienced an extraordinary series of shocks, if you think about it. The pandemic, the response, the reopening, inflation, followed by the war in Ukraine, followed by shutdowns in China, the war in Ukraine potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it. And we've done a lot of work internally on and thinking about what all that means. The thing is, you don't know whether those forces are, what extent are they going to be sustained? In other words, will we go back to a world that looks a little more like the old world, or are we really going to be in a world where major supply shocks go on and on? The history is you see these waves of supply shocks, as you did in the 70s, and then they go away, and sort of there's a new normal and things settle down. But honestly, we don't know what that's going to be. In the meantime, we have to find price stability in this new world and maximum employment in this new world where clearly inflationary forces you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely extraordinary. It's not just here. In fact, we're sort of in the middle of the pack, although I think we have, of course, a different kind of inflation than other people have, and partly because our economy is stronger and more highly recovered. So that's what we're doing. We've done a lot of introspection and work on that. And sorry, on QT, we've communicated really clearly to the markets about what we're going to do there. Markets seem to be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been. So I have no reason to think, markets are forward-looking and they see this coming. I have no reason to think it will lead to illiquidity and problems. It seems to be kind of understood and accepted at this point.
Thanks. For the last question, we'll go to Mark Hamrick.
Mr. Chairman, Mark Hamrick with Bankrate. Wonder what your assessment is about the outlook for the housing market, given the years-long increase in home prices and now the sharp rise in mortgage rates. And all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis over a decade ago. Thank you.
Sure. So rates were very low. A good place to start is that rates were very, very low for quite a while because of the pandemic and the need to do everything we could to support the economy when unemployment was 14% and the true unemployment rate was well higher than that. So, and that, that was, rates are low, and now they're coming back up to more normal or above levels. So in the meantime, while rates were low and while demand was really high, obviously demand for housing changed from wanting to live in urban areas to some extent to living in single-family homes in the suburbs, famously. And so the demand was just suddenly much higher and low. So we saw prices moving up very, very strongly for the last couple of years. So that changes now, and rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. It's, obviously we're watching
Outright
that quite
lie.
carefully.
He knows exactly what it's
over
going to do to home prices. It's going to send them lower.
There's a tremendous
He knows
amount of
this. He is
supply
lying.
in the housing market of unfinished homes. And as those come online, whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. So it's a complicated situation. We watch it very carefully. I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place and housing availability and credit availability are at appropriate levels. So, thank you very much.
You're welcome, Jay. And thank you. Wasn't that nice? All right. So, give me just 1 minute here, folks. I am going to clean up my screen a little bit because we got some stuff we got to go over there. I took a lot of notes here. Real quick, just overall market reaction to while Jerome Powell was speaking. The market interpreted Powell's press conference as very dovish. And you can see that by the indexes are higher pretty much across the board. We've got a higher NASDAQ. We've got a higher S&P. And it jolted higher initially right after he started talking, came back down. The markets didn't like when Powell did not overtly take the 100-point rate hike off the table towards the middle of the Q&A. That was these couple of red candles here, but then it slowly worked its way back up. So the Dow is up 494 points. Again, the market is interpreting this as a dovish Jerome Powell. I don't see a very dovish 75 basis point rate hike. Okay. But again, I've mentioned this earlier in the stream that the markets, sometimes the algorithms react very strongly, that this is software driven. And then tonight, everybody's going to go home while markets are closed, except some people at the banks are going to stay up. They're going to go enter new parameters into those machines. And then as soon as we open tomorrow, who knows what happens. So I caution people all the time. It's not a good idea to trade or try to get out in front or FOMO in when you see this kind of a reaction going on from the algorithms to a Fed press conference. I always set my trades in advance, and then I sit back and watch. Last time, a month ago, we saw a 1,000-point rally off of Powell's press conference, and the next day, 1,000 points down. It was all gone. Actually, I think it was like 1,100 points down the following day. So it gave back all those losses. So I would caution anybody from drawing too many conclusions based on the immediate reaction right here. Real quick, I got to send a shout out to a couple of people who sent me super chats. Thank you to Mr. S. Henderson, who said, I'm so very thankful for the protection these unelected bureaucrats provide me from free markets. I'm picking up your sarcasm there, Mr. S. Henderson. Yes, we're very fortunate to have Jerome Powell making decisions for us. And then he finishes with God bless the USA. Right on, brother. Mr. Brian Zarb, thank you for the super chat. Said, was that me quoting Mark Baum from The Big Short when I said 0% chance? And yes, Brian, you got me. Guilty as charged. I was absolutely quoting Mark Baum, a.k.a. Steve Eisman? Is that the guy's name? Steve Eisen? Who was the character of Mark Baum, was based on him. But yeah, I was definitely quoting him. All right, let's take a look what else was going on here. We got the 10-year yield actually dropped quite a bit, 15 basis points. Now, this is still higher than it was just a few days ago. I want to point that out. But a lot of dropping on the 10-year yield. That's people piling into bonds. All right, people are buying bonds. Remember, bond yields and bond prices are inversely correlated. If you see yields going down, that means bond prices are going higher. That means people are buying bonds. So we have a pretty rare thing going on right now. People are buying bonds. People are buying stocks. What else do we have going on right here? We've got people are buying gold. Gold prices are going higher. People are buying silver. I think the only thing people aren't buying right now is oil. Oil traded pretty low based on that. Now, if I had to guess this, why is oil trading lower right now? Keep in mind there's a lot of geopolitical concerns here. But a lot of the press conference was focused on unemployment. I mean, almost all of the questions were centered around unemployment. That the market, they're anticipating job destruction. They're anticipating economic destruction from all of these rate hikes and from the quantitative tightening. That could be why we're seeing oil moving lower right now. They're saying the Fed's going to cause a recession. That's my take on that. And also the Dixie heading significantly lower while Powell was talking. This is people who are spending their cash, right? We've seen the Dixie get very strong in recent days, recent weeks. That's people selling bonds, selling stocks, and sitting in cash. Well, some of that cash is being deployed right now. People are putting it back into bonds, back into stocks, back into gold. Again, the market is interpreting this as a dovish Powell. I don't think it was particularly dovish. Also, I want to send a shout out to Mr. Jose Orozco, who I met in San Antonio. Hello, Jose. He said, enjoyed the millennial journalist questions. Okay, boomer. Yeah, there was a lot of millennial journalists, but you know what? Their questions weren't bad. There was a couple of them. Honestly, I was very surprised to see very little mention of QT and only that one little mention of the housing market at the end there. Housing market is so important to the economy. I was really surprised to see such little mention of the housing market. Now, Powell's response, you may have noticed, I got a little heated when Powell responded, because for him to say, you know, that he wasn't sure what the reaction to the housing market was going to be to QT and to these rate hikes. All right, that is just an out-and-out lie. Jerome Powell knows exactly what that means. Jerome Powell's goal is to bring housing markets down. He's stated in previous press conferences before that he wanted to see a cooling off in the housing market. He knows exactly what he's doing, but it's bad politics to go on TV and tell people, I'm trying to make your house go down in value. That's not good politics for Jerome Powell, so he won't come out and say that. So that answer did not pass the sniff test. And again, if you look at what mortgage rates have done over the last few days, I did the math just before this stream started. The median home price in the United States, the mortgage payment for the median home has gone up $147 a month just since Friday. All right. That is what Powell's rate hikes have done to home affordability. Now, if the payments are going up because the interest rates are going up, but people's wages aren't going up, that means those home prices have to come down in order for those homes to become affordable again. So Powell knows this. He knows homes are going to get less affordable. That is coming. And anytime, and look what the real estate market did in 1980 and 1981 with Paul Volcker's rate hikes. Right? That's where we're heading. I don't know if interest rates will ever get that high. Probably not with a $30 trillion federal debt. But Powell knows this. All right, he's not stupid. All right. I got a couple of other notes. My God, I took a lot of notes here. By the way, the SEP. A lot of people. There was a lot of mention of the SEP in this. And I saw some people in the chart were wondering, SEP stands for Summary of Economic Projections, all right? And that's when the Fed governors put their heads together and they come up with their best estimate of where inflation, in particular the PCE, that measure of inflation, where GDP is going to be and where unemployment is going to be. So they mentioned the SEP an awful lot. Really, I think because in this SEP, a lot of people were projecting higher unemployment, which brings me to my next point. This repeated talking point that Powell had that he sees next year, inflation is going to be back at 2% and unemployment is going to be back at 4.1%. My God, I'll take things that won't age well for $1,000. Thank you. No way are we going to get 4. We're at like 3 and 3.6 right now, And we are on the verge of such a wave of layoffs. Like, we're already seeing the layoffs in the financial sector. Fintech companies, crypto companies, banks, mortgage companies, they're all laying people off, right? There are layoffs coming, and unemployment is going to explode higher in the quarters to come. That it's already starting. It's going to happen. There's no way it's going to stop at 4%. And even if that happens, with everything that's going on with this imbalance in energy markets and the lack of new energy supply coming online, and I've talked about this a lot on this channel, there's just no new energy supply coming online anywhere in the West, even though energy demand continues to go up. So inflation is going to stay well above 2% for a long, long time, all right? And by the way, the European Central Bank convened an emergency meeting this morning to talk about some emergency tools or whatever it was they were talking about doing. Folks, that's them getting ready to print money in Europe. They're getting ready to do QE, by the way. So inflation, get used to it. It's staying here. Also, we only had, what was it, 4 or 5? What was the actual, let me show j-pow's tool counter. I think it was only 5. Yeah, only 5 tool mentions. So I don't know. What do you draw from that? The fact that Jerome Powell mentioned tools 9 times, but only 5 times this time. Does that mean Powell's less focused on inflation now and more focused on unemployment? I don't know. That's interesting that he would mention his tools, which so far have been 100% ineffective in combating inflation. Jerome Powell's tools have not done anything. Inflation has only gone up since he started using his tools. He also made that same talking point that he mentions all the time that just grinds my gears when he talks about wage growth, in particularly for the lower end of the wage spectrum, to make it sound like the poor has benefited so much from his tenure as Fed chair. Understand what a bold-faced lie that is, all right? Wages, especially at the low end of the spectrum, have gone up 4.5%, maybe 5%, which I don't know many people who got a raise that big. Most people I know got a raise of about 2%, if that, all right? While their standard of living or their cost of living is going up almost 20%, while their rent is going up 25, 30%, and they're getting a 4% raise. So for Powell to come out and say that wage growth, in particular among the poor, is so encouraging is just, it's insulting. It's such a gaslighting move to say something like that. Understand, it's the inflation caused by the central banks that has made life so difficult for people at the lower end of the spectrum. And then he goes on TV in a press conference and congratulates himself for making their life better. That's what these people are doing. I mean, they're adding insult to injury when they do that. And he does it almost every press conference, and every time I grind down my molars because it really just gets under my skin when he does that. He did mention early on in his prepared remarks that they were talking about significantly reducing the balance sheet. And he also mentioned expeditiously moving our policy rate. The significantly reducing the balance sheet, that's interesting because they're starting their quantitative tightening at $47.5 billion a month, which is a really fast rate of quantitative tightening. Okay, the last time we did QT in 2018, we started at just $10 billion a month. And we slowly, over the course of a year and a half, worked our way up to $50 billion a month. And that was right before the Powell pivot, when the stock market started to crash in December of 2018, and Powell had to very abruptly start lowering interest rates, start doing stimulative monetary policy. So they're starting at almost the level that they finished at last time. This is a very significant reduction in the balance sheet. And they're talking about going as high as $95 billion in September. That's only 3 months from now. Okay, but even at that rate, even if they go up to $95 billion, it's still going to take them close to a decade to get the Federal Reserve's balance sheet back down to zero. So they have a long, long way to go on quantitative tightening. And something is going to break. There's going to be a major economic crash way before they get that balance sheet anywhere near where it used to be. And as far as expeditiously moving our policy rate, keep in mind, Jerome Powell sat on his thumb for a year and a half, right? Inflation started to rear its ugly head about mid-2020, and then it started to climb all through 2021. And he told us all last year that inflation was transitory while he did nothing, while he continued to print money and continued to prop up this asset bubble, which is responsible for these home prices being as high as they are and responsible for our rent going up so much, largely what's driven this inflation narrative. He sat there and he said it was transitory and that it was going to solve itself. And now he's sitting here saying he's going to expeditiously move his policy rate. Now he's going to tell us that he's moving quickly to address this after doing nothing for a year while our lives got more difficult. Again, this guy is gaslighting the whole world right now. But I digress. Let's see. What did he say? He said, do not expect more of this, or do not expect this rate increase to be common. That was a little dovish. And by this rate increase, he was talking about the 75 basis points. So for him to say, don't expect this to become commonplace, that was a little, I guess you could say that was dovish. Like he said, okay, we raised 75 basis points. Don't get used to it. Maybe we only raise 50 next time. But then a little later in the press conference, somebody asked him about 100 basis points, and he didn't answer. He didn't take it off. He didn't leave it. He just dodged the question. So Powell was, you could tell he was being very careful. He knew he was going to get beaten over the head with his taking 75 basis points off the table last time, only to do it this time. So he was very careful to leave himself an out in both directions. That was unusual to see that. Let's see, what else we got? Again, very little mention of quantitative tightening. QT only started today. It just started today, right? This was the first treasuries rolled off the Fed's balance sheet today. So we have not even begun to see the effects of quantitative tightening. I'm very surprised that there weren't many questions about it. All the questions were about unemployment. And by the way, the fact that all the questions were about unemployment, that just tells you that even the press is starting to realize Powell's going to crash the economy. All right. Now they're saying 4% unemployment, like unemployment's only going to go up 0.5% and it's going to stop. It's not. All right. There's just no chance it stops there. Unemployment, the job market is going to be really strong and really tight. And then one day we're going to wake up to a jobs number and we're going to be expecting an addition of 100,000 or 200,000. And we're going to get a loss of 500,000. And it's going to hit like that. And the market's going to tank. And I think we're not that far away from something like that happening. In particular in retail. Watch out in retail because, and they kind of mentioned it a little bit, that the weakness in the consumer, because everybody's spending all their money on food and fuel and rent, there's nothing left to spend in the store. And it's starting to show up in Amazon's earnings. It's starting to show up in Target and Walmart's projections for year end. All right, so that's another gaslighting thing that Powell did, was he went on and he talked about how the consumer is still spending. Overall, consumer spending is still strong. He didn't mention the fact that the only reason consumer spending is barely where it's at, is because consumer credit is on the rise. It's all going on the credit card. People are trying to maintain their standard of living by going into debt. It's happening all over the country. Consumer credit is back as high as it was before the pandemic, and it's heading higher. Right? So no, the consumer is not nearly as strong as j-pow mentioned. By the way, folks, we have 1,100 people are still watching. Thank you so much, folks, for joining. Please remember while you're here to like this video and also subscribe to my channel. We do this every time Powell talks. We also live stream CPI releases. We do those in the morning. I do regular live streams Tuesday mornings and Friday afternoon. And if there's ever a big major market event, like say 1,000-point swing one way or another, I tend to go live for those also. So I hope you'll stick around and stay for a while. Also, I just want to send a shout out to my Patreon supporters. Thank you guys so much for supporting the channel. By the way, I have my Patreon only Zoom meeting is today at 5 p.m. There is a link in the description down below if you feel so inclined to check that out. And also, Mish, I don't know if you're still watching. My moderator, Mish, the Economic Ninja is premiering a video. I think it's premiering right now. Can you guys put a comment with the link to Ninja's video down in the chat below? Go check that out because Ninja has been very politely sending me text messages saying, hey, man, I don't want to step on your stream by releasing a video while you're going live. Ninja, that was really nice of you. He is such an incredibly nice guy, and he's trying to help all these channels so much. You didn't have to do that. It was very considerate of you, so thank you. Everybody, head over to Ninja's channel and check out his video that he's doing on what Jerome Powell just did. And as soon as I get off here, I'm heading over there because I want to hear Ninja's take on what he just saw and see maybe he caught something that I missed. Only one way to find out. And last but not least, there was one question about the risk of going too far. Chairman Powell, are you afraid you might go too far? And he said he's going to try not to. And that's when Brian Zarb called me out for my Mark Baum impression. There is no chance that Powell doesn't go too far. All right, we are coming down from a 50-year cycle of easy monetary policy. 50 years all right, 40, 45, 42 years of low interest rates, of money printing, of accommodative central bank policy. And now it's caught up with us and it's causing inflation. There is no easy way out of this. There is no painless way out of this. There are two possible outcomes here: an outright economic collapse on the scale of 1929, or hyperinflation on a scale of the Weimar Republic in 1923 Germany. All right. Those are the two possible scenarios here. For Jerome Powell to say he thinks we're going to come out of this next year at 4% unemployment and 2% inflation, that is a fairy tale ending. It doesn't exist. Okay? I need you to understand that. He's got to say that because he doesn't want torches and pitchforks outside his house when he goes home. But there's just no way that happens. You cannot end 50 years of easy money. You can't break a 50-year addiction, and easy money is a narcotic economically. You can't break 40 or 50 years of addiction without some kind of incredibly painful detox, whatever form that comes, whether it's unemployment or hyperinflation. They've got to pick one, all right? Now, right now, with the rate hikes, with the quantitative tightening, right now they're choosing the route of economic collapse and high unemployment. Will they pivot and turn the money printers back on and go the route of hyperinflation instead? Only time will tell. It looks like Europe is already pivoting towards that hyperinflationary scenario with their emergency meeting that they called last night. So we'll see what happens. Only future meetings will tell. Anyways, guys, I want to thank you so much for joining me for this live stream. I hope you got a lot out of this. Thank you for sharing it. Thank you for helping get the word out. Thanks to my Patreon supporters and everybody for your super chats. I know there was a couple of people that super chatted while I was quiet. Thank you, guys. I appreciate that so much for the support of the channel. Somebody post a link to Ninja's video. I am going to post it in a comment down below. Oh my God, you guys are still going, and I missed more. Sorry, Cheeseburger. I see there. He says oil going to rebound. Yes, oil is going to rebound. And check the move index, says Aaron Levy. I will check that as soon as we get off here. But right now, I need everybody head over to Economic Ninja's channel. Give that video a boost. Let's see what Ninja has to say about what Jerome Powell just did. Until next time, live small and dream big.